Sometimes you need to borrow to fulfill your needs. But what if your bank is difficult to persuade? You want to be able to prove to the bank that you can pay them back. Because struggling with debt isn't helpful for anyone. Now, wouldn't it be nice if the banks would
I have called the people in, but I gave them 2 minutes, so we will start in a moment. Enrique. Paulo can wait there, and then I call you up. So I'm still waiting for 2 or 3 people. I think Enrico and the people from Axis, the most important ones, are not in. Here, what do you do with your members, Enrique? So you call this Beatrice, ask these 2 people from Axis has to come in. Peter Villa and Enrico. Are they still downstairs? If you call them in, please, then I can start. Enrico is outside. Okay, but I will start. So welcome, good afternoon for the seminar on what seems to be a technical issue. Yes, there they are. On credit sharing and data markets. Of course, credit sharing and data markets is a obvious, very core issue, certainly for lenders on a day-to-day basis, but an issue which I think until recently would have not attracted a lot of interest. It seemed to be an issue, a back-office issue in the banking sector, but in other sectors as well, but mostly in banking and in lending, also by whatever credit card companies, etc. But of course, data sharing now is a big issue, and we've also seen yesterday how high it is on the agenda of the new commission, everything to do with data, data privacy, creating a European space for data. We know already under the current commission it was an extremely important issue. So an industry which what we call the credit bureaus, which was an industry which we at ECRI, which is the European Credit Research Institute, have followed since the last 20 years. What kind of data are collected? How are they collected? What are the statutes of these different entities all over Europe? Has now become much more to the center because there is a lot of policy issues around data. And on top of that, there's a lot of competition around data, others which are coming in the data sector, which are competing with the traditional providers, and not necessarily the ones you think of first, but totally new one, also, or companies which are in telecoms, in big tech, and which are also trying to come into that sector. So all of a sudden, this has become a big issue. And we were asked by Axis, as I said, several members of Axis are here present, to do a study on the subject, which we performed over the last 9 months, which Sylvain did, with Giovanni, who's sitting there, and another person who's not here, let's say, which we're presenting today. So I'm very happy to present the study today, but also very happy that we have a very good panel to discuss it in a moment. As I said, ECRI is an entity run by CEPS. CEPS is an independent think tank. It's an entity in the house which is specifically funded by as well banks which are in the consumer credit field, as well as credit bureaus, or what you call, what is now the official term, let's say credit bureaus, I think, but also some IT companies which are also in the sector. And we're doing work on issues related to credit payments and also impact of technologies. So we started the study, as I said, about 9 months ago. I mean, the team is here, will be presented in a moment. And it was Axis, the Federation of the Credit Bureaus, which asked us to do the study. So before passing the floor to Sylvain for a presentation of the study and then a panel discussion, I wanted to hand the microphone to Enrique, who's leading the organization in Brussels, for a few words of introduction.
Thank you very much, Carol. I'd like to begin by asking you a question. Who in the room has a mortgage credit? Can you raise your hands? Who is planning to buy a house? I mean, those that didn't raise their hand. Okay. Among those that have not yet raised their hands, who has bought a washing machine or a TV on credit or is buying? No one. Who hasn't got a credit card? Or who has a credit card? Fine. Who is paying a phone or a utility or a water bill? I imagine everyone. And that is credit, because you're using a service and you're paying it later. So to those that in one way or another use credit, I have good news. Data sharing among creditors on borrowers' data increase access to more consumers and in better conditions to credit markets. This is not something that I say. This is something that has already been very well researched, and international organizations like the World Bank have acknowledged this. So I have mentioned to you borrowers, I have mentioned lenders, and I have mentioned data sharing through credit infrastructure. These are the three pillars of the credit ecosystem. And I think you will all agree with me that from a societal perspective, it is in our best interest that the credit ecosystem delivers and performs well. As images speak louder than words, we have prepared a short video for you to explain to you what we are, what credit references are, and how we operate. And now I love to say, enter video. Beatriz, enter video.
Sometimes you need to borrow to fulfill your needs. But what if your bank is difficult to persuade? You want to be able to prove to the bank that you can pay them back. Because struggling with debt isn't helpful for anyone. Now, wouldn't it be nice if the banks were trying their best to win your favour? This is where credit reference agencies can lend a hand. They collect objective information about your payment behaviour, such as the types of credit you already use, how long your accounts have been open, and whether you've paid your bills on time. They then use that information, which is kept secure, to prepare credit reports and credit scores. Or, simply put, they vouch for you when you say, "I'll pay my dues." So, get ready to borrow and check your credit report with a credit reference agency today.
So, as the video tries to explain, CRAs sit in the middle of the credit ecosystem between creditors and consumers. CRAs are the helping hand, a helping hand that in an objective and neutral way tries to bring these two together. At Axis, we were persuaded that this helping hand could in fact help more. And we thought that data sharing could have a more beneficial impact on financial inclusion if credit reporting and sharing systems across the EU would be more comprehensive. In other words, if more relevant, granular data, including non-traditional data, could be collected, shared, and used in creditworthiness assessments. This perception was backed up by the fact that CRAs operate in a number of countries across the EU, and in these countries we have different levels of depth and breadth in the data collected. So, as Carol explained, last year we decided to sponsor a study on the relationship between the comprehensiveness of a credit reporting system and the fulfillment of the roles that the credit reporting system has in the economy. After a tender process, we found partners in ECRISEPS and in the University of Edinburgh to do this. And irrespective of the findings that will be presented later on, and this is very much for the panel and for you to judge, what I would like to leave with you as Director General of Axis is that for us the important thing was the independence of the study and the robustness of the work. This study that you are going to be presented now is a scientific analysis that employs sound econometrics on a database on credit reporting information that, according to the researchers, is among the most complete worldwide. I can announce to you that we plan to continue growing this database and that in 2020 we will publish a new edition of our Axis membership survey. So before moving on to the next block of the event, I would like to warmly thank Sylvain, Giovanni, Carol, with whom we've worked over the past 9 months, and the whole research team for their professionalism and the stamina that you have had in carrying out this project. So thank you also to you for coming to the event today and for being so kind to accompany us today. Thank you.
So you already started my introduction. So I will directly go to the core issues. So this is a study. So I will try to put a bit the context also on the research side. I will be a bit technical because this is very important. I mean, as we get very interesting findings, to emphasize how we managed to get these findings. So overall, the literature, when you go for different papers, if you go, for example, the papers of the World Bank, what they try to do is to show that in countries where you have mechanisms for sharing data and countries where you don't, you really have a big difference in terms of what you achieve for the credit markets in terms of stability, in terms of, access to credit, etc., etc. Also, this type of research was driven by institutions like the World Bank, as Enrique said, which has a global mandate. And as you know, they compare different continents, a very large sample of countries. So there, definitely, you have many countries where you don't have these mechanisms. So it makes sense, to analyze the question through this framework. What we try to achieve with this study is to cover only one part of the sample, which is Europe. The different European countries, where if you investigate, you have institutionalized mechanisms for data sharing in credit markets for many, many years. So we have different types. It can be a central bank, can be a CRA, it can be a CRA owned by the banks, it can be a complete independent private business. You have different setup across countries, but for each country, we do have this institution. So there is no really question about does it make sense to have a mechanism to share this data. But what makes sense, as Caroline and Enrique emphasized, is to know if, because it's touching very sensitive topics, is to know whether more data is better for credit market. Collecting more data helps reinforcing the robustness of credit markets. It's what we have tried to answer in that study. So the main question is to see that to assess whether higher comprehensiveness in the data collected in credit markets and this data is shared is good for European credit markets. Obviously, and I will get back to this, to get metrics on comprehensiveness, this is a big challenge. Now, this is something I will get back a bit later. And this is related to the first specific question, because we see two layers in this question. One is to go after what we call the traditional credit data. So traditional, what does it mean? This is a big question. Every country has almost a different definition. We don't pretend in the study to redefine what is traditional. What we can say, to make it simple, is that it's a type of data that has been mostly used in the 20 last years in the business of the credit business. This is way institutionalized. This is typically structured data, which is collected by CRS. Also, it can be, it's mostly CRS, but it can have, as I said, a central bank or different institutions who do it. But let's not be naive. In the 20 last years, we all know we had this big emergence of what we call the big data. So there are many new types of data available on the market. Some was already there, but we never really used them. We never really tried to do something with it. I will get back to that afterwards. And that's why to really answer this question of comprehensiveness, the impact of comprehensiveness, we need also to get beyond what we call the traditional data, and to also go to non-traditional data, which is covering a very large set of types of data. And that's something we try to address in our study. Yeah. So I will directly, like that there is no suspense, but I will just give the main findings from the beginning. So the finding one, we show in the study with the model and the assumptions we use that more comprehensive data does boost the access of consumers to credit. This is something we could show empirically. The second finding is more comprehensive data raises the propensity of banks to channel savings into consumer credit. And the third main finding is more comprehensive data reduces the risk of missed repayments. Here we have like three core functions, if I may say, of what is supposed to do a credit market, as Enrique emphasized, which is first ensure a satisfactory level of financial inclusion. The second one, to ensure that the resources, the deposits are also allocated to what we can call the real economy. And the third one is to ensure financial stability. About non-traditional data, so the first finding what we got is that, and that could be expected, structured non-traditional data is generally preferred.
What is structured non-traditional data?
Thanks, Carla. You anticipate my next statement. So structured versus unstructured, I think one part of the room knows well, and the other part maybe it's a bit more abstract. So structured is really what we call the relational data, is that we can be put directly into a database. For my name, I have an age, a number of years of education, a weight, a height. The weight can change, but we have different pieces of information that we can easily classify in a two-dimensional database. Unstructured means by exclusion all the other types of data. So we know it can go from our talk on Facebook, but it can go also to pictures. There are many types of data, but we cannot directly incorporate in a database, in a two-dimensional database. So as expected, structured non-traditional data, and I will give more examples later on, is generally preferred. By exclusion, unstructured non-traditional data is attracting mixed opinions, depending on the stakeholder we talk to. The third core finding, we show that, there we didn't show it, but that was the perception of the stakeholders we interviewed. The main benefits of non-traditional data are primarily the increase in predictive accuracy and access to credit. And finally, and that's also no surprise, and might be also related to finding one, the main challenge is legal compliance. Now let's go into the details of the sub-question 1. So does higher comprehensiveness in the data collected by CRS impact European credit markets? So as said before, the three core objectives, when we try to measure the comprehensiveness, is to see that if we have more comprehensiveness, does it impact access to credit, the propensity of lenders to channel savings into consumer credit, and the risk of missed repayments? I will go a bit through the methodology because obviously when you get powerful results, it's important to give a bit more details on the methodology. So on that side, we have a two-stage methodology. We really did an extensive work to really review the literature on this topic in order to find an adequate database to conduct empirical analysis. World Bank does have, as you may know, databases to measure this comprehensiveness. However, as said, this is a very large sample. So there are many countries with very different situations. So it's very difficult for them first to have comparable findings, comparable data. It's a big challenge, that's the first thing. And secondly, it's also very difficult to be very detailed. So you, for example, as Enrique already emphasized, breadth and depth, if you consider depth, the question is simply, are you collecting positive data? Yes, you get 1, no, you get 0. So that's how we consider that for a sample, a European sample, it will not give such interesting finding if we only limit it to Europe. So we investigated to get the right database, and as said before, we realized that there is this database built by, this survey, in fact, built by Axis with its members every 2-3 years, which is very granular. There are many questions. We get really, really refined information. So we started the study from this tool. As you can imagine, we had also to work a lot to consolidate this database. So to ensure that first it's consistent across CRAs and across countries, it's consistent over time, and it's accurate. So that's something we have done. Now we have a pretty big database with a lot of information. This is something still we discuss to see what we can do with it, if it's shared in public domain or not. We'll see with that. And based on this consolidated database, it was possible, to assess, to try to conduct econometrics, panel econometrics. The number of observations, for viewers who are familiar with econometrics, is rather limited. We have up to 60 observations. So at first, if you ask an econometrician, he will tell you, it's never enough. You always need more. But if you do the literature review as we did, you get to the papers that are quite, are like landmark in this type of analysis. Many of them do use this number of observations. That's something they do, World Bank included. So based on this, we're pretty confident that we can build a robust model. So as, again, the ones who are familiar with econometrics, as you may know, you have many parameters to use, to control for many issues, to control for other factors. So it's a big, heavy work to get something that we can say at the end achieves an acceptable level of robustness. And we are confident with this model, based on the assumptions and all the control we have used, that we get something with an acceptable level of robustness. If I answer a bit for the different indexes, which could be interesting also on the, definitely on the policy side. So there we are not original, we divide breadth and depth. So what we consider as breadth, as you see, you have a list of let's say the sub-indexes within the general index of breadth. So we have types of borrowers, could be, for example, consumers, could be SMEs. We have the types of data collected on borrowers. So you have the core data, my identity, can be the financial wealth, can be, etc., etc. We have the types of organizations supplying data to CRAs. There, as Carol said, it's often a back office issue. So as a consumer, you don't often suspect that there is so many stakeholders involved in the process. And there we could see that it could be retail banks, leasing companies. And there are many different types of organizations that can supply this data. We also have the types of loan services. So it can be mortgage, consumer credit, information on these different products. And finally, and that's also pretty interesting, and we're very happy to have these components in the database, we have a small window on the non-traditional data issues. This is only mostly, I would not say only, mostly structured non-traditional data. For example, utilities. Some data is collected on the, financial data, on your payment behavior with your providers for TV, phone, energy, etc., etc. Is it better with the microphone now? Yeah. That's for the breadth side. Then we have on the other side the depth index. There it's, at first it looks like it's simply divided between positive and negative. That's true. Now, also very interesting there, this is very granular. We got many items there. So we can get really refined indexes on the depth of the positive data and on the depth of negative data. Now we enter the finding one. So what we try to do, not to be with tables and many figures and with stars and etc., etc. We try to do simple simulation with the findings we got. So there what we try to do is when we increase the index of general breadth by 0.1. So what means 0.1? To understand this well, all the indexes we use are between 0 and 1. So if you increase by 0.1, you see it's a significant increase. When we do this, meaning CRS in all Europe decide to boost the breadth by 0.1, what's the impact in terms of credit access? What we show there, so it's to show that before and after the increase, you have a significant impact of an increase in breadth on the market. So if I take consumer credit to GDP ratio, which is our first proxy for the financial inclusion, can be discussed. I mean, I know that's something, definitions is definitely something that can be discussed and challenged. I'm happy to take questions there afterwards, if there are. We see that taking the average of the sample, 7.8% across the sample, which is cover most of the EU, will pass to 8.1%, so an increase of 0.26 percentage points. Some people might say, that's only all this for this? Only for this? In the complex world of today, nonetheless, it's very important to emphasize that everything, I mean, every changes you have the aggregate figure here, which is 0.3 percentage point, but also you have the numbers behind. So there we have to remember, but it's probably a few millions of people. That's one thing, important thing. The second chart, it's about, we get data from the World Bank to have the share of people who have taken credit in the, yes? Yeah, that's something we did. I mean, this is something we can discuss after, but this is definitely all the parameters we use. We also try to control for this, doing different testing, and the tests are not perfect, I agree, but the tests we got in general were pretty confident. They confirm that we can use this. Yeah. Then, considering, because, okay, that's fine, we have the whole economy, consumer credit to GDP ratio. Now let's enter a bit more, because there are big questions on the policy side. What about the people who have economic, let's say, difficulties, and the people who have less economic difficulties? So there, what we call in a bit, sorry for the expression, poor consumers, and the other one, rich consumers. That's data provided by the World Bank. So the share of these consumers who have used the credit in the 12 last months. And then what we see, again, and that could be a bit even surprising, we were not really expecting this, but here again we see there is a significant positive impact on the share of people across income groups, so we could get other types of income groups. We have a significant impact of an increase of general breadth. Which means one thing there, and that's important, because there are two main effects when you get more data on your pool of potential borrowers. You have the ones where maybe you were lending too much before you knew about this consumer. You say, okay, now I know who is really. I'm like, maybe I was a bit too optimistic, so I will reduce the lending. And you have the second group, which is about the opposite, which is we don't have so much data, we don't know you so well, or we use the data and we are thinking we should not lend too much, and now we get more data, we say, in fact, you are safer than we thought. So we have these two opposite effects. And what shows this chart is that the effect 2, I borrow more to the safer borrowers, is above the first effect. That's what shows, I mean, this is an interpretation we can do of these three charts and findings. Another one, I said before, this is this question of, we'll try to not to extrapolate too much there, but I think it can give some food for thought, this type of analysis. Is banks collect all these deposits, what do they do with it? we try to show. This is based on, obviously, I should re-emphasize this, everything you see, I mean, is also based, it's in continuity with the empirical literature which has been conducted before, to show that when banks get, I mean, CRS collect more data and share it with the banks, they tend to allocate more, I mean, resources from deposits to consumer credit. And the last one, we try also to model the risk of missed repayments. So with a lag variable to control for different factors. And we can show that here on the non-performing loan ratio, which is the one of the IMF we use as a proxy. Again, we could interpret it as, yes, when you get more data is shared on credit market, it helps reducing, I mean, the risk of missed repayments. Why, to summarize this sub-question, after I will go to the next one, we are, as said, we are very happy, I mean, to do a bit empirical stuff, if I may say, because often in Brussels, we are trying more to summarize perspectives, opinions, I mean, on things like this. But there we really did a hard work to try to get something empirical. Obviously, the methodologies we can discuss afterwards. I think maybe it's not the exact place to do it now. This is something we're happy to take on board afterwards, I mean, to improve the model. But we are pretty confident with all the assumptions and everything we did that could be sound enough, I mean, at least to question the policy framework. Now, if I go to the second sub-question about non-traditional data, there we use a different survey because, as you can imagine, quantifying, I mean, finding a proxy to mirror the amount of shared non-traditional data, it's mission impossible. So we did a survey with different stakeholders to assess if this, when you increase the comprehensiveness by collecting more non-traditional data, it does help financial inclusion and it does reduce the risk of missed repayments. There, the methodology is in 2 stages. The first one, so it's a conduct of interviews. So we have a limited number of stakeholders. However, it's quite diverse stakeholders. We have consumer associations, CRAs, retail banks, startups providing credit in different countries. And we could see there was some sort of inertia, if I may say, within the same type of stakeholder group. So we get interesting findings there, which was completed by desk research. This exercise, unfortunately, my colleague is not here today, was conducted by University of Edinburgh. So also, I think if you're interested in getting more into details and methodology, you can get back to, for example, me, and I will put you in contact with the University of Edinburgh. What we see here, the big question, structured versus unstructured. So this is really a passionate debate. So what we see is that non-traditional structured data is, finding one, the more useful type of data for affordability assessments. The thing is, what we put in, because in the survey, we try to have really exhaustive list of the types of non-traditional data. And it looks like there probably there is a big, the big driver is what we call transactional data. So this is perfect timing to discuss that now with the PSD2 schedule these days. That there is this conception, and we have banks here, they can tell us more about it, that banks don't really use in an optimal way the data they have in-house. And that's, if you open it, maybe there are many things that can be done to increase the quality of the credit market, especially regarding affordability assessment. Finding 2, and let's not be also naive, this type of data is more socially and legally accepted so far. We have all the privacy issues. Also, after we'll enter to this as well, the quality of the data, I mean, et cetera, et cetera. Now, if we get to non-traditional unstructured data, so it is promoted by some stakeholders. fintech startups, retail banks. So as you can imagine, there is a big difference between the two in the sense that fintech startups are much less shy to say we use it. It's used as a mainstream process within the fintech startup. Obviously, they don't have the same reputation, risk as the retail banks. That's also can explain that. While retail banks, from what we understand, they test it, but don't really use it, from what we know. But they say it would be, let's say, sad not to try to see if we can do something with all this. And the finding 4, it is highly criticized by another part of the debate, which is, which includes consumer associations. That's a shame. Today we are supposed to have one of them here in the session, but unfortunately he couldn't come. But there, the reasoning is like this, is, look, there are already so many types of data, traditional data or non-traditional structured data. Why not trying to optimize this before entering the non-structured, non-traditional types of data? The main benefits of non-traditional data. So the finding 1, and that's something, it was said in the survey, but it's also confirmed in the literature review, is that non-traditional data in general increase predictive accuracy of credit risk models. This is particularly true when traditional data underperforms. Where you don't have sufficient amount of traditional data, where the traditional data has a low quality, there the non-traditional data could be a very useful complement. The second aspect, it also increases credit access. It can help. That's a finding that all, even consumer associations, depending on the types of non-traditional data, but it's something which is clearly emphasized. It helps also to have a more holistic view of a customer. And finally, and that's also a key issue, maybe less in Europe than in some other parts of the world, but it's also more important for consumers within credit files. I was in China a few years ago, to discuss credit reporting, and I was very surprised at the beginning that there, at least 3 years ago, they were quite open to all these new types of data, to be used for creditworthiness assessment. Why? Because a very large part of the population, it was impossible for this part of the population, they were saying the figure 85% to have decent data to do creditworthiness assessment. So that's a core topic there. In some parts of Europe, it makes sense. We have also big pockets of European residents that don't really have financial data. So there, this is a critical point as well. And I will finish with the main challenges. For anyone, it's legal compliance. There is still, we're in a transition period. That I'm very happy to have the European Commission here. Maybe they can give some food for thought there on how they see these things progressing in the future. The second one, and not to also underestimate the quality of the data. A lot of non-traditional data is not good, and there is a lot of work to be done before transforming it, refining it into something good. The third one is the IT technological difficulties. So you have a fixed cost at the beginning when you enter this game. You need the skills. You need also the processes, to be able to use them in an appropriate way. And finally, there is obviously the social acceptance and ethics. And there, obviously, there are the questions of privacy. This is something definitely to be discussed. Maybe in the session, we can also address this issue. And overall, it looks like there is a potential there. It's not consistent across the different set of non-traditional data, obviously, but there is a potential there. I know if University of Edinburgh would be here today, they would say they are happy, to dig more into this, if some of you here are interested, to consider also the policy side, etc., to get more, research on this topic. So I will stop here. I will stay in the session. I will have to leave earlier. Sorry for this at 2, because I have to take a train and after a flight. But if you have questions directly on the study, maybe we can address it more at the beginning of the session. Thank you.
Okay, thank you, Sylvain. And if I can invite Paolo, Enrico, and Fiona on the stage, we'll have now about 1 hour, let's say, to debate the findings of the study. I mean, unfortunately, as Sylvain said, let's say there is no consumer. The representative from Berg had to call off yesterday. He was somewhere mistaken in another engagement which he had. So, but there are certainly consumers in the audience, say they can also react. So I'll start with the Commission to react on this study, and probably if there are things which are not clear, I will interject some questions, but I think there's a lot of wealth in the study. To some extent, things are evident. Of course, the more data you have, the better you can do consumer credit, but of course, there are lots of problems related to this, as we'll certainly hear in this panel. So, Paolo, you kick it off, and then I will pass on the floor to the other speakers.
Thank you, and thank you very much for inviting us to be here today, to participate in this debate. Yes, this study is very interesting, and indeed it's focused on an issue which is very much in the order of the day. I would like just to briefly complement what you just presented with the legal framework on the processing of data for creditworthiness assessment purposes. So I will, of course, this legal framework concerns in particular consumers, because the use of data for assess the credit of a company does not pose particular problems. But when the consumers are concerned, that's why we have very specific rules. And I will start with the Consumer Credit Directive. I can see that my colleague is there. They are conducting the review of this directive right now. And Article 8 of the Consumer Credit Directive says that you have to conduct a creditworthiness assessment which to evaluate the ability of the consumer to repay the credit. And in order to do this, you should collect, or the credit institution or the lender, in this case, should collect sufficient information to come to a conclusion. This sufficient information has been interpreted by the Court of Justice of the European Union, saying that it should be information, the sufficient nature of the information may vary depending on the circumstances in which the credit agreement was concluded, the personal situation of the consumer, the amount covered by the agreement, but it shows that there is underlying this assessment the principle of proportionality. So you should collect information which is proportionate to the purpose of assessing the creditworthiness of the consumer. The Mortgage Credit Directive, which was adopted in 2014, is more specific, has more specific rules on creditworthiness assessment. They are similar, but it's more specific, and Article 20 says that this assessment shall be carried out on the basis of information on the consumer's income and expenses and other financial and economic circumstances, which is necessary, sufficient, and proportionate. So this is the important point. The information has to be necessary, sufficient, and proportionate. Then we have the European Banking Authority has published for consultation in June this year guidelines on loan origination, which include also a chapter on consumer, the creditworthiness assessment of consumers. And in an annex, they have included the types of data that can be used for this creditworthiness assessment. And they refer to evidence of employment, income, information on financial assets and liabilities, financial commitments, tax status, and data from credit reference agencies, amongst others. But this is not enough. This legal framework is completed by GDPR, the General Data Protection Regulation, and in particular by Article 5, which refers to the principle of data minimization, which says that you can only use the data which is necessary to fulfill a specific purpose. And in the context of consumer or mortgage credit, the credit institution will process the data for the creditworthiness assessment purpose on the basis of performance of a contract. So the legal ground to process the data under GDPR for this specific purpose is performance of a contract. And this legal ground in GDPR says you can only process the data which is necessary for the performance of the contract. The European Data Protection Board has interpreted this notion of necessary, saying that it will not cover processing which is useful but not objectively necessary for performing the contract. So the burden of proof is on the controller, the credit institution, which has to demonstrate that it needs to collect the data because this data is necessary for performance of the contract. So coming back to the study, of course, more data could be useful to for creditworthiness assessment purposes. But this is utilitarian assessment. It's the legal one says it has to be necessary. This is already a point I would like to make.
Could I ask you, Paulo, what you mean with this? Meaning, only if it's necessary you can do it. What does that mean?
Yes, I was going to explain it. For instance, if there is a credit history for a specific consumer has a credit history, this credit history should be enough for assessing its creditworthiness, to assess its creditworthiness. So we should not complement this with other data which is not necessary for that. On the other hand, if we have a consumer which has a thin file, and so there is no credit history, then indeed other data could be collected in order to complement and to allow this creditworthiness assessment to be concluded, to be conducted. But again, it is for the data controller to show that it needs to collect this additional data. On the other hand, I have other general considerations that perhaps I would like to make. First, I do not agree at all, and this is a personal opinion, that with the principle that all data is credit data, for the reasons that I just explained. Some of the fintech that are using processing data for creditworthiness assessment purposes, they prone this principle. And just to give you an example, there is a specific fintech which is collecting 20,000 different data points for granting loans up to 5,000 euros. So they are using 20,000 different categories of personal data to grant a loan of up to 5,000 euros. Where is the proportionality on this? This is completely, I would say, under the existing framework, illegal. So the credit data is the most rich and revealing one. In absence of credit data, then eventually, like you refer, PSD2 opens new possibilities, because PSD2 allows, for instance, account information service providers to have access with on the basis of a contract concluded with the consumer, to have access to the different payment accounts of the consumer, so they can collect payment data in order to provide and help the bank conducting the creditworthiness assessment. But the major, it has been shown also that the major problem with the non-repayment of credit, it's not so much related to data that you can the historic data that you can access. It's related to lifetime events such losing a job, divorce, or a serious illness. And these events are by definition non-predictable. Even if you have the data, you cannot predict if someone is going to lose a job, have a divorce, or have a serious illness. So this is the main, I will conclude, then I will reply. So again, this kind of puts in perspective also the usefulness of having collecting more data. In member states where only negative data is used, like for instance in Belgium and France, there is no evidence of higher levels of over-indebtedness of consumers. So this is something that remains to be explained, because there is no much difference between Belgium and France and other member states where more data is processed. Then there is also a fundamental problem with credit scoring, because it has happening today that you get credit scoring to obtain a loan, but then this credit score is used as a proxy, for instance, to rent a house, to have a mobile phone, a contract with a telecom company, to even get a job in the United States. I don't think it's happening in Europe, but in Europe, to get a house, you already have to present, in some member states, to present your credit score. So this credit score, which is originally conceived for getting a loan, is invading all other aspects of your economic and social life. So you would have to comply or take good care of your credit score. Otherwise, a lot of other opportunities in your life will be closed down, or you will not have access to them. So, and finally, credit score means that data is collected, is transformed by mathematical models, algorithms, and transformed into a figure. And the problem with these algorithms is that they are, by definition, non-transparent. They are proprietary, so the company using an algorithm will not explain how it works. If you want to challenge the final decision because you didn't get a loan, you will have extreme difficulty. GDPR requires or provides, it's not a very clear, but it's a right to explanation how the algorithm works, so you can challenge the decision. But this would work with the more traditional algorithms. Now you have what we call the machine learning, so it's evolving algorithms or learning algorithms, which are produced by the computers themselves. And so it's, in the end, not even the creator of the first algorithm now knows how the algorithms that have evolved work. How is it possible to explain the decision taken by these algorithms? This is very special. And this is, I think there were a question over there, but I will give.
We can take probably one question, but I would like to hear the other panel members as well. If there is one urgent kind of explanatory question, yes, please. Question only, no comment. There is a microphone there if you wanted to. And if you could introduce yourself as well, please. It's not on, I think, the microphone. Or keep it closer. Mine is working. Anyway, you can ask your question just like this. If the microphone doesn't work.
I didn't say that data doesn't have predictive power. Of course, it has predictive power. That's with relation to lifetime events. Even if some lifetime events, if you collect data on your lifestyle, and your genetics, of course, you will be able to predict whether you have a major illness down the road. But this is socially unacceptable. We are not doing this because that we have laws which do not allow this for insurance purpose. For instance, if you contracted a life insurance, and if the company was able to collect data on your lifestyle, on your genetics, it will have a very pretty accurate data or scenario of how you could evolve. But even then, it does not foresee a possible accident. So there are data which is certain life events which are not predictable, others which are predictable but are not, or could be predictable but are not acceptable under the existing legislation, and so we are not using them. In any case, even if you collected, in this case, collecting data on lifestyle and on genetics, it would be considered excessive data. The principle of proportionality would not apply here. So
okay, let us move first to Fiona. I mean, we have basically two key representatives here in the panel. First of all, a representative from one of the largest banks active in this domain, Santander Bank, and then we have also a head of a credit reference agency in a moment, Enrico Lodi, also one of the biggest in Europe. So how do you look at this as a big user of data all the time? Fiona.
Okay, let me say that I have some discrepancies with some of the things that have been said here. Basically, I'm going to illustrate SMEs, probably because most of the experimentation we've done has been on enterprises, obviously because we have a lot of restrictions on privacy for individual customers. So that's why I'm here, so I can tell you what our findings are. But what we have found, first of all, is that the use of more data improves the predictive power of our models in all our geographies, and it also improves the accuracy of our repayment or affordability calculations. That's a fact, okay? We are in 10 major geographies all across the world with very different data sets and very different legal environments and very different, we have countries with positive data, countries that do not have positive data and so forth, okay? And that has proven to be so everywhere. The fact that we have an improved our models accuracy has resulted in a much lower NPLs all across the table in all countries, so we've experienced that. And that has helped improve our risk-adjusted profitability, which in turn has resulted in additional funds for the retail banking business. Obviously, we are competing with other businesses, so we have to be profitable. That in turn, and together with the fact that we have improved our models, has resulted in greater financial inclusion and safer financial inclusion. So those are our conclusions, which are very much in line with the study. As far as data is concerned, especially for SMEs and the smaller end of SMEs, we traditionally have had major issues on data because traditional data such as financial statements, cash flow projections, and other types of data do not work for smaller SMEs. Basically, for major reasons, they're not required to do them, and if they do them for banks, they're pretty much useless in most jurisdictions. So we have worked a lot on different types of data all across geographies, and we have seen that what here is being referred to as non-traditional data can have, can really increase predictive power in our models. Okay. We agree also with the results of the study that say that still repayment past history data, past repayment history data, it's very, very powerful in our models. But we do have different types of data that are very, very useful. First of all, is transactional data. We've been using transactional data for many years in our own customers. What has been changing recently is that we've increased, initially we only looked at current account data for our customers. Now we're looking, and we have found that it's very, very powerful to look at other types of data, and in particular for SMEs, point of sale information is extremely relevant. We actually use that, especially in Latin America, to include customers that otherwise we would have no data on them. And a lot of them may not have past history. So we use point of sale terminal data because there we know exactly how much they're selling, what's the frequency, what are the trends, and eventually we can give them credit.
But people are willing to give this.
What?
People are willing to share this data. In Latin America,
this data we have access to it because they're our point of sale terminals. And we know that data is extremely powerful. Now with PSD2, we as banks have access to our own information. The new change in the law with PSD2 is that we will be able to access other banks' data as well. Okay, so that will give us a much better profile of the customer. And for smaller SMEs, normally they tend to bank only with one bank. It will increase competition. Okay, because right now only the primary bank of the SME has access to that information. If they allow other banks to have access to that information, that should in turn increase competition. Because we see a huge increase in the predictive power models, and we can be a lot more assertive. Okay, that's the truth. As far as other data that is very, very relevant, business networks. And business networks, normally we can use transactional data. That's another thing that has recently changed. We categorize data, we read the data much more than we used to. So that allows us to see who are our customers' providers, our customers' suppliers, our customers' clients, and so forth. And that has helped us understand much better the customer, and it has helped us a lot also, especially in Latin America, invoice finance data, which allows us to increase a lot of lending using invoice finance information. Other types of data, which may be not so socially acceptable for individuals, but they are acceptable for SMEs. For example, we're looking at what we call social prestige data. Basically, let me give you an example that probably all of you know, TripAdvisor. We have hotels, we have restaurants, bars, and so forth. People actually rate them. Well, that's very predictive. Okay? We have found that information is predictive and correlates with risk. Okay? That information is public, that's why we can access it, because people are not giving an opinion about a person, they're giving an opinion about a business. Okay? Types of data, additional data that we have tested or we have tested some part and some part is in the actual process of being tested. And here we don't agree so much with the results or at least not with the classification that it's used in the paper. We don't believe this is about structured or unstructured data, okay? In the sense that it's more about whether it's private or public data, okay? In the sense that we have found that some unstructured data may be relevant and predictive. For example, we may scrap information on the web about news about our customers, okay? There's nothing wrong about it. It's public information. So why not use it? Why not access our commercial registers to see if we have seen a change in the composition of our customers and so forth, okay? That increases the predictive power, and that's very, very relevant for customer monitoring. Especially, as you know, SMEs are extremely correlated with the cycle, economic cycle. So, you know, any signs of alert or our monitoring is extremely important, okay? So we use all that type of data to improve our models. In addition, and this is why I talk about public and private, because even companies have private data or data that needs consent. Let's not forget that. If I want to access tax payment information, I need their consent. If I want to go to credit bureau, I need their consent. If we want to go to another bank's data and capture the data, we need their consent. So this is about requiring consent, or it's public. It's not only about individuals only, okay? And finally, and surprisingly enough, well, it's not so surprising, tax data is predictive in some countries and it's not in others, surprisingly. Probably because in some countries there's a lot of tax fraud, but we do try and get all the data and see if it correlates with risk. And finally, we are looking at some data, what we call digital footprint or digital track. For example, some of the data that has proven to be very useful for fraud detection, such as device type, IP, timestamps, customer location, when they come into our apps or our websites. We are looking if it correlates also with risk, okay? And we are testing. This is all just testing ground, Google search maps, and so forth. We are obviously in the SME space, so a lot of this data is public, so we can do that. We haven't done this test on private individuals because obviously there are privacy issues that are very, very relevant. And so we believe, and this is our position, is that we believe that the control should be given to the actual owner of the data, okay? Public data obviously will not need consent. All other data should require consent, and we should give it to the owner of the data. That's our belief. They should decide freely who they want to give that data to, and also, we also believe that to have a proper data sharing framework is not only about also giving control to the owner of that data, but it's also about how safely that data can be transmitted. And if we want our customers to actually benefit from it, that data should be provided in a safe manner, and it should be immediate. So that, for example, the same way that in PSD2, we've been requested to build APIs so we can transmit that data, and that data can be used immediately online to grant credit at another institution. Well, different types of data, additional types of data should also be provided the same way, especially with people that are competing with us in the credit space, such as big techs and telcos and fintechs and so forth. We believe that we should all play with the same rules, basically. And finally, this is very, very important. The data we believe should be shared, should be raw data. Obviously, if companies build value around that data, they should be able to retain it. And therefore, that data should not be shared. For example, if we develop algorithms that actually improve either the quality of data, or if we develop algorithms that actually can provide much better or faster services to our customers, we should be able to return that value. That's really our position. We believe the world is changing a lot, and also what we have seen is that all this data sharing is actually generating a lot of innovation. And I think that's very good for SMEs. In new business models, new distribution channels. So we really believe this is going to be very, very good for the economy in general. Okay, so and I can give you some examples. I can obviously, for confidentiality matters, I can't give you the names of the countries or anything like that. But we have some examples, and in one country, we've been able to pre-approve additional limits for SME customers for about 300,000 customers, just because of this improvement in our models and our predictions. And that has we've improved, granted an additional 800 million euros. In another country, we've been able to pre-approve an additional 1.8 billion euros of credit limits that we made available to SMEs that otherwise we would have never given them that amount of money. So we really think that helps. That's our position. And all of this lowering significantly the risk and the cost of credit. We look at the two, not only granting credit, but it has to make sense. And also we believe that and we are working a lot on that, and the accuracy in the repayment capacity, it's also very, very important, not only from our perspective, but also from the customer perspectives. We don't want to over-indebt anybody. We believe, it's got to be a good business for both sides, for the bank and for the customer, obviously. So that's...
Okay, thank you, Fiona. I mean, that's very clear, and that supports, let's say, the findings of this study. But we're going to have a discussion afterwards what is necessary. Only one very quick question, because we need to go on.
Could you explain us?
There is a microphone, and please introduce yourself.
Sorry, Tom Weingart, I'm a journalist. Could you explain us, please, how do you make this with this point of sale information? Is this, let's say, in Brussels, if someone buys his bread in Sablon, he gets more credits than if he buys his bread
what happens is...
And is it quantified?
Points of sales, and this has been, we had a spectacular growth in Latin America using point of sale data. What we do is, the little point of sale, by the way, it's just the little machines, when you go and pay with a credit card, that's the one. Well, each bank offers their SME customers point of sales, okay? In some countries, they may have more than one, but, normally they tend to, the smaller end of SMEs, maybe they work with one bank. We can read that data. And that data will actually tell us, for example, whether in the last X months, whether the trend of their, sorry, the name in English, of their turnover is increasing or decreasing, and we can see whether they have a lot of customers or they're very concentrated in one customer, and things like that. That type of data is actually very important. So we collect data for some time, and then we start giving them smaller limits. And once we start getting payment information, because payment information, by the way, it's very relevant to not only credit bureau data, but also internal payment information. Once we start getting that information, then we can start giving them larger limits. So it's like something that, progressively, the more we know, the more we can give you. Okay? And it's also very good for if suddenly, we start seeing that, for example, sales are, rapidly decreasing and so forth, then we adjust limits. We tend to reduce them because maybe they won't be able to repay. So we've used that data to grant credit to businesses that otherwise we would never given them any credit.
Great, very interesting. We move to Enrico. Enrico is running a big credit bureau or a credit reference agency, that is the formal word, in Italy, and has the experience from kind of the database manager, so to say.
Thank you, Karen. Yes, I do have.
It's on.
Maybe it works or it doesn't work.
No.
Maybe you can hear me anyway. Okay. I do have two hats. One is as president of Axis, so representing the credit reporting industry in Europe, and the second one is as managing director of CRIF, which is one of the Axis member and is a credit reporting agency operating in 40 countries in 4 continents. So I do have 3 points. Number one is that we do have a research, objective research. I'm working with this industry since mid-90s, and this is really the first research which quantifies the statements that have been presented today. And you might say, why just in 2019? Because probably data was not available, I don't know. But to me, this is very much important because it, you know, when you sit, I'm Italian, no? If you go to an Italian bar, you can sit with your friends and talk about politics or football, and you have an opinion, your own opinion. It is not based on evidences. This research helps in addressing a discussion starting from evidences. And that's my point number one. And I would like to say that, by the way, among the evidences coming out from this research, there are some evidences that I do not like. Reading the executive summary of the research that you gently provided us in advance in order to prepare ourselves. There is one statement that, for example, I do not like. Results reveal that established lenders are more willing to share data when capital requirements are more constraining, and the risk of competing with new players is limited. In addition, higher concentration in credit markets tends to limit data sharing. This is a conclusion that I do not like very much, but I take it as an evidence I do have to play with. And by the way, coming back to a point raised by Paolo and connecting the dots, might explain why, for example, in France, they do share only negative data, because the market is so much concentrated that the big players are credit bureau by themselves. My second point, I mean, being the third after this kind of panelist is very much difficult, no? Because they offered a number of gimmicks. Okay, let me take one point. If my understanding is clear, Paulo Silva talking about we do have to be very much aware of the regulation that says that we do have to performance the evaluation of the contract utilizing the necessary data set. He said, I'm referring to consumers. It is not about companies. And in fact, Fiona told us a number of analyses that has been made by Santander on the small and medium enterprises customer. What I'm saying is that from the perspective of the credit reporting agency, I'm in the middle between lenders and borrowers and the regulation too, no? Because those are the 3 angles. And I do want to stay into the rules, making easier for lenders and borrowers putting in place their deal, which is buying a product via a post-paid facility, which might be a loan or might be also the postponement of a telecom bill payment. our industry is made of incumbents. So we don't want to stay at all into the rules, because we cannot bear the risk that some fintechs might take elaborating, I don't know how many data points, as Paolo was saying. So here the point is that starting from the objective evidences provided by this research, we do have to navigate understanding which is the best way for utilizing the data that now the technology and the new regulation are offering. PSD2 is the first example. In order to making easier for lenders and borrowers making their own deals. The exciting moment we are living is that things are changing very fast. So to me, the real point is let's start discussing utilizing the evidences, objective evidences we do have. Please stop sitting in the bar talking about opinions about our preferred football team, which will be by default the best one, or our preferred politician. That's my takeaway from today's presentation of the research performed by SEPS and ECRI. Thank you.
Thank you, Paolo. I think we had a good cross-section of views on the subject. I think certainly some big issues came out, but now it's up to you to raise questions. I mean, this is a core subject and will become even more core in the, I think, months and years to come, and is a big legislative issue also in Brussels, as we heard. Eventually, how they will approach us, we'll have to see. Who wants to kick it off? Who has points you want to raise, questions? Yes, there are two hands already here in front and then at the back.
Thank you. Stuart Holland from Equifax. We're a credit reference agency as well. So my takeaway from this is that if you have more comprehensive information, you have more financial inclusion and more consumers are protected from over-indebtedness, but that there is a trade-off with privacy, and the current legislation is around this necessary and sufficient wording. Paolo, when you described that, you spoke about that using extra data would be necessary when somebody had a thin file, so the data could be collected in that circumstance. How would that work in practice? So somebody would check with a credit register from the central bank and with a credit bureau, and then they would see the person didn't have the data, so then they would have to, how would they gather that extra data? So the way it works at the moment is the credit reference agencies and the registers collect a certain amount of data and then it's checked. So I'm just wondering how you square that.
Probably shall, yeah. I mean, we have two other questions, but shall I take 2 or 3 questions at once, or probably yes?
Okay, hi, Serena Holm from Schufa, also a credit reference agency. I have also questions to Paolo. If I'm not really sure if I understood you correctly, but you made a point between usefulness of data and necessary of data, and I'm not really sure where the distinction is here, because if it's useful, so useful in the terms of better creditworthiness assessment, so better predictiveness, all the facts that you pointed out, Stuart, like lower over-indebtedness, all that comes from a better creditworthiness. Isn't that then means that it is necessary, or where do you would put a line, or is there a line between those two for you?
It's
2 very similar questions, yes.
Yeah, I will start by, if you allow me, with the last question, because it's not me saying that. I was quoting European Data Protection Board guidelines, on the performance or on the processing of data for performance of a contract. And they say Article 6.1b will not cover processing which is useful but not objectively necessary for performing the contractual service or for taking relevant pre-contractual steps at the request of the data subject, even if it is necessary for the controller other business purposes. So if you, they have a guideline, so it's just a quote. They explain better in their guidelines because they're quite extensive. And to come back to your question, which is also related to this, I think in practice, the bank will try to find out if the consumer has a credit history. If it doesn't, so it will have to look for alternative data so it can conduct the creditworthiness assessment. It will have to ask, like it indicated, for instance, in DBA guidelines, data on the employment, on tax status, and if still this data is not necessary, but again, the burden of proving it is for the credit institution, then it could ask for transactional data or use the transactional data it already has on that client. And by the way, we hear about the alternative data as the argument is also always financial inclusion. Well, I would say that for me, the most important step on financial inclusion was given with the adoption of the Payment Accounts Directive, which provides every European citizens with the right to a basic payment account. So when we talk about financial exclusion, we are referring to people who do not have payment accounts, who are unbanked. This is the way. So with this directive, which was approved in 2014, everybody, including refugees, have the right to a basic payment account. This is indeed the most important measure of financial inclusion. And once you have a payment account, then transactional payment account data becomes available. Just if you allow me to get back to some of the comments made with regard to my intervention, we do not diverge because most of your intervention was on SMEs and most of mine was on consumers. And I focus in particular in consumers because there is this thing which is called a fundamental right to data protection, which is inscribed in the Charter of Fundamental Rights of the European Union, and which is extremely important. That's why we have these specific rules, because we don't want to find ourselves in some kind of dystopia where, like for instance, which is happening already today in China, where you have a credit scoring, and then depending on the credit scoring, you are forbidden to have access to a train, to a plane, to inscribe your kids in school, because everybody's, if you don't have enough credit social credit scoring, you are forbidden for a lot of things. So, and this is the kind of dystopia that we are protected here in the EU. Second, just some clarifications. Just because personal data is public, it does not mean that you can do whatever you want with this data. You still have to have a legal ground to process the data. If you do process the data, you have to inform the data subject that you are processing their data. And you have to comply with the principles of the GDPR on the processing of the data. So it's not because it's public that it's up to grabs for anybody who wants to use the data. Second, because data protection is a fundamental right, is not legally correct to talk about the owner of the data. We are not owners of the data because I don't own my data because I cannot alienate it. It's a different. It's not in the kind of ownership rights. And finally, yes, on France and negative data, it might be so, but they are forbidden to use positive data because there has been a decision of the Cour constitutionnelle which says that it's not compatible with the French constitution to have databases processing positive and negative data. This is where it starts from, and it was based on an opinion from the CNIL, which is the French Data Protection Authority.
But it is an
Any-
opinion like in a bar.
No, it's
No,
not
no,
opinion.
no, it's a-
The decision of.
Now I'm joking.
No.
I'm joking. I'm
Sorry,
Like in the football, like you said.
I'm a lawyer. I don't joke with that things.
I'm joking.
No,
Just joking.
no, I don't joke with the decisions of the highest courts in the country.
I have two further questions. Agnes at the back, and there was another person next to you, I think, or yes?
Thank you. Agnes Lecek from the European Commission. I have a question to Fiona, and I'm quite ignorant about the subject. So I wanted, you were saying that information on point of sale on SMEs was very useful for you as a bank to provide loans to companies. Would you be willing to share this information to others, like other banks, which means that they could also get your clients, but possibly you would get their point of sale information about these companies and be able to access their clients, meaning more competition, etc.? What would you think of this?
I personally, yes. Okay.
And Santander as well?
I haven't asked the question. No, well, we with PSD2, we will be sharing current account data, okay? And that's a big step, okay? I don't know, but let's put it this way. We could share a lot more data, but we also need others to share data that are competing with us. That's the major point. I really believe that we should have a level playing field. It's the same way that we are going to give our data to others. Others should give us the data as well. That's our position. We are not only competing with banks anymore. We are competing with telecoms. We're competing with big techs. We're competing with fintechs. We're competing. Let's put it this way. Industries are blurring. Everybody is trying to do everything. So if that's the case, a level playing field requires that we have the same access that they have. And what I mean, it's not just about portability. I don't know if you've ever tried to ask your social network to tell you what data they have on you. First of all, you'll be lucky if you find the button to ask for it. And secondly, they'll send you a PDF file that it's useless. What we're saying is, if us as users, we want to benefit from it, we should be able that our data should be really be portable, truly portable. And that means we should have APIs, from other competitors as well, not only banks. But so far, we are the only ones that, are required to share that data.
Yeah, there's a question here in front. Oh yeah, there's a question there as well. Yes, wait a moment. Probably we take the two at once, but quick question. Yes, please.
Brent Oyen again, Ernst & Young. I think Fiona raised an interesting point where she mentioned that one of the main goals for them to use more data is to achieve profitability as an end result. Did I understand that correctly? That one of the main reasons why you're using your data better and improving your models is to achieve profitability. Did I understand it correctly from...
No, what I'm saying is, as a consequence of using much better our data, we've increased profitability because we've reduced NPLs.
But is that, would you say, is that one of the key considerations then to
no,
invest
what
in
I'm
new technology?
the argument is, well, first of all, let's be real. We are banks. We lend other people's money. Let's not forget that. We are very much concerned about consumers, but let's not forget that, we have to protect the deposits of lifetime savings of a lot of people. We're not talking about that here, but that's part of our job. Now, obviously, we can't lose money, okay? So what I'm saying is, a bank gets some funds, and then they have to decide where to place that money, and obviously they will place it in the safest and more profitable businesses, okay? Because that's what we do, okay? That's our basic intermediation function. Now, What I'm saying is, if we are able to lower NPLs, as a result, our profitability will improve, and more funds will be directed to the retail businesses. Because let's not forget, we compete with other businesses. Okay, that's what I'm saying. There's an allocation, and that's how banks work. And it does make all the sense that banks work that way, because we are lending other people's money. Let's not forget that. It's not ours.
Yes, a question here. I'm Viktor Nagy from Hungary. I have two questions actually, one for Mr. Silva and one for Ms. Caboni. The first one would be that Mr. Silva mentioned that the information collected should be necessary, sufficient, and proportionate. How can the controller decide that the data collected is proportionate? Is there any specific guideline that says that this is proportionate, but this amount of data is not proportionate? Or who is deciding at the end that what is proportionate?
Yeah, very good point.
Enough. And my second question is for Ms. Caboni. You mentioned that you use public data, publicly accessible data for credit decision, in the credit decision-making process. How can you control the public data, the quality, and if, for example, if you decide based on the public data and it turns out that the public data is wrong, not good enough, then how can you control that and the decision based on this?
Who decides if the data is proportionate? Well, it's not only proportionate, it's necessary. If the data is necessary for performing the contract. There are guidelines. There are guidelines from, like I mentioned, from the European Banking Authority on the creditworthiness assessment in the context of the mortgage credit directive, but the new guidelines will also have a chapter for the first time which applies to consumer credit, but when, of course, the consumer credit is granted by a credit institution. It could be granted by other lenders. And there are guidelines with regard to the processing of data by the European Data Protection Board, for instance, on the processing of data under the Article 6.1b, which is the performance of a contract. So you have guidelines already available, public, to allow us to make that assessment.
Okay, as far as the quality of data, what we do is we build models. Okay, well, I don't want to get too technical, but the idea is we have like a score that measures reputational risk. Okay, and the way the model is built, obviously, if you only have one source saying, let's say, there's something wrong with this company, but you have 100 sources saying the contrary, okay? Maybe that's not very relevant. When you build a model, all of that is taken into account. Actually, initially, the reputational risk model was built for us because we want to know what people think about us, okay? But we thought it might be an interesting idea to replicate that with our companies. And now what we want to do is test whether that correlates with risk. Maybe the answer is it doesn't. And then we won't use that information and we'll stop using it, okay? But there are ways, and obviously if it doesn't, very often about data, and I have some comments on the EBA guidelines, the famous EBA guidelines. We've raised some major issues for SMEs because they distinguish the world is black or white. You either a consumer or you're a professional. In professional, you include everything, you know, up to large corporations, okay? And the way they're proposing that we do the credit worthiness analysis is of a large corporate. And their requirements are of data that is not available for SMEs. That's one of the issues. So going back, for example, how do we know that financial statements may not be very, may not be right for SMEs? They don't predict risk. So there's something there that's telling us there's something wrong with that data. So, we have checks and balances of ways of checking whether that information is correct or not. We don't normally trigger alerts only on one thing. We normally tend to build alerts on even, for example, to monitor our customers. We just don't, we don't react when we have one new or one bad thing. We normally build a model that tells us what is the probability that something is happening with our customers. That's the way we do it. So we don't just jump at the first thing that we see.
Okay. I was just going to ask you a question before you add.
I would like to make a comment, if you do not mind.
Okay, then
because it's connected to what has been discussed.
Yeah, okay.
Thank you. I mean, proportionality and competition are very much and customer satisfaction are very much connected. If we go back to the 60s in Europe, the credit bureau, credit reporting agencies operating at that time in Europe were maybe 2 or 3. One in Germany, Schufa, one in Austria, KSV, maybe very few. Why? Because in the 60s, credit was granted only when secured. So the paradox was, if you are rich, you can get credit. If you are poor, you cannot. The flourishing of credit reporting agencies across Europe, starting from the 70s to the end of the 90s, is because a new guarantee, immaterial guarantee, was more and more utilized. My credit history. Irrespective of the fact that I am rich or poor, I can prove that I am a good payer. And that's enough. Unsecured lending growth, which has meant that a lot of people, families, have been access to a better life. So, when we talk now about proportionality, competition, and customer satisfaction, is simply the same old story that we are putting in a different historical environment. Why? Because in the 70s and in the 80s, when credit reporting agencies were flourishing in Europe, the big banks were against the development of credit reporting agencies. Why? You can understand it. Because the sharing of information would have been more beneficial for the small ones other than the big ones. Proportionality. At that time, the idea to collect data on individuals in many countries were felt as, let me say, an abuse. Now is done. Customer satisfaction. People in the 70s and the 80s, the son of blue collars, were looking for getting to the university and finding a way for having a better job. And financing, unsecured financing of these dreams made them able to take the elevator pitch. Sorry, but this is the point. We do have evidences, clear evidences coming from this research that we do have to review this mix, adapting it to the current time. Proportional, fair in terms of competition, and answering the questions that consumers are putting now. And fully respecting, indeed, the fundamental rights. But I think that no one might argue. But the point is, what kind of balancing we can find in order to move in that direction, starting from the reality of today? Because the facts are there. More data are available. A new regulation on data protection has been issued, and many other regulation has been issued across the last few years. And consumers' needs are changing and calling for new stuffs. It's not an easy job, but it's a fantastic job to be done now, because it is really a great momentum, challenging any one of us. Sorry, Karel.
No, but I will not ask you a question anymore. Probably I'll ask Fiona or Paolo whether she or he have any final comment, because we probably have 2 or 3 minutes to go, and then I want to close it. So, Paolo.
Thank you. It was an issue that I wanted to address, and I forgot it. It's the issue of over-indebtedness and non-performing loans. Why do we have such a high load of NPLs today? One of the main reasons are related to the fact that when consumers took a loan, in particular, I will refer the area I know better, it's mortgages, they were not fully aware of the impact that the risks they were incurring. For instance, there were a lot of consumers that took foreign currency loans. They took a loan in Swiss francs, then the Swiss franc exchange rate changed, and then they find themselves in the situation where now not able to pay anymore the loan they had taken in the Swiss francs. And so this is a case that was dramatic. It reached, there were thousands, if not millions, of Europeans that found themselves in this situation. And now we have the Mortgage Credit Directive addresses this by requiring that member states adopt measures limiting the exposure of consumers to exchange rate risk. There were other issues. For instance, I'm thinking about Spain, because yesterday there was the opinion of Advocate General on also in Spain related to mortgages. Banks that were using index or to establish the interest rates, which were not clear, transparent, clear. So, and the consumers did not fully understood the impact the index could have on the repayment of the loan. And now this case is before the Court of Justice of the European Union, and this could have a tremendous impact on Spanish banks if they are required to compensate the Spanish consumers. So what our legislation is aiming at, including the part on creditworthiness assessment, is to make sure that these situations will not repeat themselves, and that the consumers will be protected and have proper pre-contractual information, that they are fully aware of the risks they are taking, and that they are able to repay their credits. We are not, it's not a question of being against open data, because in fact, if anything, we adopted the PSD2, which promotes the sharing of data. So this is most clear example that the Commission is in favor of sharing data to generate more competition. the right to data portability in GDPR has the same objective, is to allow more competition on the use of data subjects data. But we have to have more competition with some safeguards, in a way that the data will not be used in a manner which is not compliant with the most fundamental rights of the consumers.
Okay, thank you, Paulo. Any final word? No? From your side, Fiona, very briefly?
No, not really. We are big fans of data sharing, basically because we can see that it does, it does improve financial inclusion, and I think that's very relevant for SMEs and especially for the European economy. So
certainly, also as a bank which is active in countries where the average level of wealth is much lower than it is in Europe.
Yes,
and you can see
we
it
have
from
found that
perspective
if we use that type of information, we can actually reach a lot more SMEs. That's
okay. That's probably a nice note to finish this debate. So let me thank Sylvain, who's left already, Paulo, Fiona, and Enrico. I think for an interesting debate on a subject, as I said in the beginning, which was a few years ago seen to be, but has become really to the forefront with all the, as a result of competition, privacy concerns, issues about, also data sharing between all different entities. Then there's things about proportionality and is it necessary and so on. So I think there is still a lot in there for us to follow.
I have a question. Where will be made available
the research report? Axis asked us to wait until today, but it will be from today on our website. Beatrice will make sure that it's on our website, and we'll also have a brief kind of a summary. Anyone can download it. It will be for free, and the data will be shared, but we'll also try to make sure to promote it to the media. We have a short summary ready, which Giovanni prepared, so there is a kind of a press release type summary ready. And I try to promote this debate, but we're certainly open to have continued this discussion. And with this, I want to thank you all certainly for your patience, for listening that long, and for your input into the debate. So, and thanks Axis for having co-organized or for having come with this idea to do this together with ECRI and SEPS, this work. So thanks a lot and have a nice trip back. And if you have any other ideas on what we could do on the subject, just please don't hesitate to contact me or my colleagues. Thanks a lot.